Hi, in this video I am going to explain another approach of financial management, that is about modern approach. In the previous classes I have explained about the traditional approaches of financial management, introduction about the traditional approach as well as limitations of traditional approach, which I have explained in the previous class. So in today's class I am going to explain the second part of approaches of financial management, so that is about modern approach. The modern approach is an analytical way of looking into financial problems of the firm. It means the modern approach always analyze the financial statements, or it is called as an analytical way of looking into financial problems. Means they will analyze, they will study the financial problems, and then they will come to one particular solution for all the financial problems. So that's why it mainly in modern approach the skill is applied, how the funds to be utilized, or how the funds can be utilized in the better way, or how effective utilization of fund is possible. That is the main concept in case of modern approach, which was not there in case of a traditional approach. According to this approach, the finance function covers both acquisition of the funds as well as allocation of funds to various uses. So both acquisition of funds, raising of funds as well as distribution of funds are the part of a modern approach. The main differentiation between traditional approach and modern approach is, in traditional approach it has given importance only for the acquisition of fund, means raising of fund or for borrowing of fund, whereas in case of a modern approach both acquisition of funds as well as distribution of fund, allocation of fund, using of funds, both are given importance, or both are given more importance or more significant in case of modern approach. And that's why modern approach stands higher when compared to the traditional approach. And financial management is concerned with the issues involved in raising of funds and efficient and wise allocation of funds. So in modern approach, the financial management function has two division. One is a raising of funds and another is a efficient use of funds, efficient distribution of funds. Two concepts are included in case of a modern approach. According to modern approach, the term financial management provides conceptual as well as analytical framework for financial decision making. The modern approach provides conceptual as analytical framework for financial decision making. It means while taking any financial decision in case of any business unit, it all provides information theoretically, conceptually, as well as analytically. It will help the finance management, or it will help the finance manager to take a sound decision, so that through that they can overcome all the financial problems. The new approach views the financial management in a broader sense. New approach means modern approach is considered as a new approach of financial management, and it study the financial management in a broader sense, or it study the financial concepts of a business unit in a broader sense. So therefore it has a higher value in case of a financial management when compared to traditional approach. It viewed as, or it has an integral part of overall management. In case of any business unit, now the financial management has its own importance because of modern approach, and modern approach gives entire picture of financial activities of a business unit. So that is about the modern approach. Modern approach covers three basic financial decision, that is one about the investing decision, and about financing decision, and next is the dividend decisions. These are the three integral part of financial management under modern approach. And this chart will give you information about the financial decision, dividend investment decision, financing decision, and dividend decision. Under investment decision, capital budgeting and working capital management, long term as well as short term financial decision, whereas under financing decision, cost of capital and capital structure decision. And next is a dividend decision, that is about the declaration of dividend or how the dividend should be distributed in an effective manner. So these are the main three parts of financial decision, and which comes under modern approach, or which has been given vital importance under modern approach. So therefore modern approach of financial management is more familiar or more famous when compared to the traditional approach. Let me explain one by one about the investing decision, financing decision, and dividend decision. Let me explain first part of financial decision, that is investment decision. Investment decision means the investment decisions are the financial decision taken by management to invest funds in different assets with an aim to earn the highest possible returns for the investors. It involves evaluating various possible investment opportunities and selecting the best options. And from the financial management point of view, it is the invest of funds in different assets which will provide good return, high return possible for the investor. Investor here is a businessman, entities or companies, they are the investor. And this investment decision will help the company to take the right decision or good decision about which assets they have to borrow and how it will give the good return, how it will contribute in the future to get more profit, more return. So that is about the concept which comes under investment decision. Evaluation of various investment opportunities, evaluation or assessment of various investment opportunities where the fund can be distributed and where there is a good opportunities and which sector will provide the good return. So that is the concept which comes under investment decision, which sector they have to invest more, whether it is on marketing, whether it is on manufacture or on advertising or on the distribution sector, which sector they have to invest more and which will provide good return. So that has to be selected in the under investment decision. So that is comes under a investment decision. There are a lot of factors which comes under a invest decision, or lot of areas which has to be taken into consideration before taking any investment decision or before taking the distribution of funds, or at the time of allocation of funds they have to consider these areas. The first one is about ascertainment of total income, total volume of funds a firm can commit. Ascertainment of total volume of funds a firm can commit. So how much funds can be raised by a firm, that has to be ascertained first, and how much fund they raise. The first, this is the second part of financial management, the distribution part, investment part now. And before taking the investment decision, they must know volume of their money, volume of their funds, then they have to take the decision of investment. So that is ascertainment of total volume of funds. And next is appraisal and selection of capital investment proposal. The appraisal and assessment as well as selection of a particular investment proposals on the basis of their requirement. Measurement of risk and uncertainty in the investment proposals. The risk and uncertainty, the risk and reward part or risk and return part should be measured, should be analyzed. Prioritizing of investment decisions, the which one they have to take the first, that is about the prioritizing of investment decisions. And next one is the funds allocation and its rationing, distribution on the basis of its importance or its significance. The proportionately it has to be distributed to all the sectors, so that has to be distributed on the basis of its significance. Next is a determination of fixed assets to be acquired. Which assets, the fixed assets, they have to be borrowed, that has to be determined, that has to be fixed in the beginning itself, means they must have the proper plan which fixed assets they have to be acquired and which is again required for their business unit. And next one, determinations of levels of investments in current assets. The level of investments, how much fund to be allocated for the reserve for the current assets, that also to be determined, like on inventory, receivables, cash, marketable security, etc. And their management. This has to be planned in the beginning itself, means before distribution of funds. And buy or lease decision if it is required for the company. And asset replacement decision, fixed assets replacement decision, replacement of furnitures or the building or the machineries or equipments, anyone, if it is necessary. So if the funds are available and if the funds are raised for that purpose only, then they have to make necessary arrangement for the replacement of fixed assets. Next, restructuring, reorganization, mergers and acquisition. So this is again, if it is a part of their plan, part of their investment, then only they have to consider. Otherwise, these are not required. It is not applicable for all the entities. It depends on for which purpose they raise the funds. And next is a securities analysis and portfolio management. They have to analyze the securities analysis and portfolio management. The portfolio means bundle of investment avenues which the particular company have. So that's about, they have to manage it and they have to analyze it. Then they have to make some changes which will help them to take better management decision, better financial decision. So that is all the concepts which comes under investment decision. So next part of a modern approach is a financing decision. Of course, investment decision, financing decision and dividend decisions, these are in together, they are called as a financing decision. In that, one of the decision is a financing decision itself. The financing objective asserts that the mix of debt and equity chosen to finance investments should maximize the value of investments made. It means that it is a mixture of debt and equity, and it has to be proportionate or mixture in such a way that it should maximize the value of investment made. Financing decision, it is like the combination of debt and equity. It should include both debt and equity, mixture of both debt and equity, and it's like capital structure. It's a capital structure, and it should be in such a way that it should maximize the value of investment made, means it should give the good return in the future days to the company. So that is about the financing decision. Equality or maintaining the balance between debt and equity is a very important. Whenever any business unit they succeeded in case of maintaining the balance between debt and equity, then definitely they can reach their objectives. The debt equity mix should minimize the hurdle rate, allows the firm to make more new investment and increase the value of existing investments. How it should be there, the mix between the debt and equity, in such a way that it should minimize the hurdle rate, means it may minimize the problems, means there should not be imbalances, there should be always balance between debt and equity. So it should minimize the hurdle rate so that what the company can take more new investments, means hurdle rate allows the firm or the company to take more new investment decision, means they can expand their business, they can start their new branches, or they can take the new investment decision. So where they can where they can increase the value of their present investment. So that is in such a way there should be combination between debt and equity. So it is the duty of a finance manager, or it is the function of a financial division or department of a business unit. So then next, there are some factors or areas which has to be considered under financing decision. So here I am going to explain some areas which are to be considered under financing decision. Determination of degree or level of gearing. The level of gearing, again, it is a combination of debt and equity. The mixture between the debt and equity, the balance between debt and equity, that has to be determined. The proportion of debt and equity. Generally 1:2 is a ideal proportionate or ideal capital structure is called as a 1:2. So it may change. So the ideal capital structure is a 1:2, or ideal debt equity ratio is a 1:2. Again, if there is any fluctuations in that, then they have to maintain that particular capital or that particular relationship or ratio between debt and equity. And another is a determination of financing pattern of long-term funds, which areas covered under financing decision. So determination of financing pattern, the structure of finance for a long-term funds. So that is the another part which comes under financing decision. Next is the determination of financing pattern of medium as well as short-term funds requirement. First is a financing pattern of long-term funds, as well as another part is the determination of financing pattern of medium and short-term funds. All are required for the business. Without that, they cannot run the business. With the only long-term funds, it is not possible to run the business. So they need short-term funds, medium-term funds, or long-term funds. The next part is a raising of funds through the issue of financial instruments. Financial instruments like securities. In total, we can say that securities, either ownership or the debt securities. So through that, through the issue of financial instruments, they can raise the fund. So that has to be determined. And next one is another part, arrangement of funds from banks and financial institution. So they can make arrangement of funds by borrowing the loan from banks or financial institution. Next is arrangement of finance for working capital requirements, short-term financial requirements to meet the working capital requirements. So they have to make arrangement. So later I will explain about working capital, so that separate concept comes about the meaning or other concepts of working capital. Next is a consideration of interest burden on the firm. So that has to be considered, the burden of interest on the unit or on the company. Next is a consideration of debt level changes and its impact on firm's bankruptcy. Imbalance between debt and equity, that has to be monitored. If there is any changes, then whether its impact is there on the firm's bankruptcy. So then the company has to take, means finance department has to take some measurements to maintain the balance between debt and equity. And next is a consideration of various modes of improving the earnings per share and the market value of the share. So this is also very important. Taking some measures to increase the earning per share and market value of the shares. This concept again comes later stages. So there I will explain in detail about the earning per share and market value of the share. Here it is just what are the areas will comes under finance decisions. Next is a consideration of cost of capital of individual components and weighted average cost of capital to the firm. So cost of capital as well as weighted average cost of capital to be considered of the company. Again, separate concepts are there related to cost of capital as well as weighted average cost of capital. There I will explain in detail. Again, here we are just the areas which comes are which covered under financial decisions are only covered. The next is optimization of financing mix to improve return to the equity shareholders and maximization of wealth of the firm and value of the shareholders. That's also part of financing decision. Portfolio management of the company. And another is a consideration of impact of overcapitalization and undercapitalization on the company, on the profitability of the company. Consideration of foreign exchange risk exposure to the firm and decisions to hedge the risk, manage the risk. Next, study of impact of stock market and economic conditions of the country. So that is all the part of a financing decision. Maintenance of balance between owner's capital to outside capital. Maintenance of balance between long-term funds and short-term funds, part of financing decision. Evaluation of alternative use of funds, so that has to be taken by the finance management. Setting of budgets and a review of performance for control action, setting the budgets and monitoring of performance mainly for the purpose of control action, and preparation of cash flow and fund flow statements. So these are the part of or areas of a financing decision. There are a lot of areas which comes under financing decision, and you are going to study in detail in the coming units about all the new concepts or new terms which you are heard through in this particular concept. So that is I am going to explain in detail in the coming classes. So here it is only the what are the areas comes under financing decisions. The next part is a dividend decision. Now the third part of basic financial decisions or modern approach of financial management is a dividend decision. Dividend decisions concerned with the determination of quantum of profits to be distributed to the owners and the frequency of such payments. See here it is one point you can note that the determination of quantum of profits that has to be distributed to the owners, to the shareholders, and the frequency of such payments, regularity of such payments. So that is mainly comes under dividend. The part of earnings or the part of profit which has to be declared as which will be declared as dividend to the shareholder, to the owners, and some companies will distribute frequently due to some reasons, due to some factors. So there are a lot of concept again which comes under dividend decision. Why the some companies declare the dividend, why some companies not declare the dividend. There are a lot of factors. Here just I'm going to explain about the meaning because it is a part of modern approach. So in modern approach, it is a one part. Dividend decision is a decision which has to be taken by the financial management. So that's why it is included under modern approach. The dividend decision will affect in two ways: the amount to be paid out and its influence on share price. Then another one, the amount of profit to be retained for internal investment, which maximizes the value of firm and ultimately improve the share value of the firm. The dividend decision of the company will affect in two ways. One is whenever they declare the dividend, the amount to be paid out and influence on share price. Whenever they declare the dividend, it will influence on the share price of the company. And second one, whenever they retain the profit, if some part of the profit declared as a dividend and some part retained, or if the entire part of the profit is retained for internal investment, which maximizes the value of the firm and ultimately improves the share value of the firm. If they retained the profit without declaring the dividend, or if only some part of the profit is declared as a dividend and remaining part retained by the company, then why they are retained for internal investment purpose, and which will improve the value of the firm and also the share value of the firm. So there are a lot of factors in regarding this. In detail I will explain in coming classes. And there are a lot of factors which has to be considered again under dividend decisions. The areas which has to be considered under dividend decision. First one, determination of dividend and retention policies of the firm. How much dividend to be declared, how much part of profit to be retained, whether it is partially to be declared as a dividend, partial part of the profit to be declared as a dividend or not, whether they have to retain the entire profit in the company for future development. That has to be determined by the finance department. Consideration of impact of level of dividends and retention of earnings on the market value of the share and the future earnings of the company. So they have to consider if the dividend declared, how it will impact level of declaration of dividend and retained earnings. So impact of level of declaration of dividend as well as retained earnings, that has to be assessed. Next one is the consideration of possible requirements of fund by the firm for expansion and diversification proposals for financing existing business requirements. So whenever they have the future plan or whenever the fund is required for a future expansion or any other financial to meet any other financial requirements or to fulfill any proposal to start the new proposal, then they can withhold the declaration of dividend. Only some part of the profit can be declared as a dividend, remaining they can retain with themselves for the future expansion. So that has to be considered whether they have any financial problem, whether they have any financial requirements, or whether they have any future project or proposals, then they can retain the profit without declaring the dividend. Next is the reconsideration of distribution and retention policies in boom and recession period when they have to declare the dividend. Sometimes dividend has to be declared to retain the shareholders. So they have to reconsideration of distribution and retention policies in boom and recession period. It is not fixed. The dividend rate of dividend is not fixed. Every year that will change, and that changes is based on the boom and recession period or based on the economic cycle. So that is about that also, that point has to be considered whether they are in the boom period or recession period, what is the present business cycles or what may come in the future, that has to be considered. Then they have to take the decision of investment. Next is considering the impact of legal and cash flow constraints on dividend decision. The impact of legal and cash flow constraints on dividend decisions, that has to be considered. So this concept, again there is separate unit related to dividend declaration or dividend concept, that I will explain in detail, or you can study in detail about the dividend decisions. So this is about the dividend decision, one of the part of modern approach of financial management. So this all about the modern approach of financial management. In the previous classes, I have explained traditional approach of financial management. It has narrow scope, whereas in case of modern approach, the financial management has a widened scope or broader scope. More areas are there under modern approach, or it has covered more areas in for financial management. So therefore there are three divisions. One is investment decisions, and another is a financial decision, and another is a dividend decisions. There are a lot of concepts which you have to study under these three areas of modern approach of financial management. Thank you very much.